Welcome to Buy, Hold, Sell. My name is Matthew Kidman, and today we have Steve Johnson from Forager Funds. Welcome, Steve, and Tim Carleton from Auscap Asset Management.
Thanks,
welcome, Tim. And today we're talking about the Steve Martin portfolio of stocks, planes, trains, and automobiles. And we'll kick off with the big airline in Australia, Qantas. Steve, you've got a view, had a terrific run.
Sell. Terrible business long term. I think it wasn't as bad as people thought it was at the bottom, and it's not as good as people think it is at the top. And I can't believe how cyclical it is in terms of stock price. I understand it's a cyclical business, but people get carried away on the upside and carried away on the downside.
No one likes airlines, Tim,
True.
as a long-term investment. How about you, Qantas at the moment?
We don't like airlines as an investment either, but I'd have the stock on a hold. I mean, there's a couple of tailwinds, a reduction in the competitive threat, lower oil prices. We're not sure how far either of those will go, but it might still have some way to run.
And how about another stock where the planes land, Sydney Airport?
Great business, one of the best monopoly assets in the world, we think. Still yielding just under 5%, growing at mid-single digits. That's a pretty attractive total return in this environment. Buy.
You like that infrastructure asset, Steve?
Same. The corollary to my views about discretionary spending in the wider economy are, I think we will see lower interest rates in Australia. I think we could see them substantially lower over a 3 to 5 year time frame, and some of these stocks like Sydney Airport are going to look good in that environment. It is probably, or it's up there in the best businesses in Australia.
Off the plane and onto the train, Aurizon, buy, hold or sell?
I think it's got some similar characteristics in terms of people buying it for yield, but it's exposed to a very different space, and some of that pain from the commodities sector has to be passed on to the infrastructure owners at some point. There's a lot of coal mines out there in Australia that are being kept open just because they have take or pay agreements with people like this, and I think that's going to come under pressure.
So sell?
Sell.
Are you that bearish, or can the infrastructure asset hold up out there?
We would agree with Steve. I think ultimately there's going to be some impact from lower production volumes at some point. The stock's trading above where we think fair value is, so we'd have it on a sell.
Let's hit the road. One of the outstanding performers has been the road asset Transurban.
Yes, it's been a great performer for us as a hold. It's now yielding in the low fours. A lot of the increase in traffic has occurred. For us, the total return's not attractive enough for it to be a buy.
Too expensive, Steve, even though it's a terrific asset?
Yeah, I'm really kicking myself about this because I've had this view on interest rates for a long time, and it was one of the really obvious beneficiaries from lower interest rates. I'll say hold, but I still think in a portfolio that you're preparing for a lower interest rate environment, I certainly would not be tossing this out. And I think along with Sydney Airport, it's one of the better infrastructure plays in Australia, and I think you'll see that yield be appealing in the environment that we're in.
All right, let's jump in the car. Automotive Holdings, there's a smell of maybe consolidation in the industry. Do you like Automotive Holdings?
I don't know the stock that well, so I don't have a strong opinion on it. I've read the same stuff as you, as everyone's talking about consolidation, and overseas we've actually seen this trend play out for a number of years now and be a very profitable business. So I think there's some merit to it, but I don't have a strong view. So does that mean hold? Yes.
We'll take a hold.
I guess so.
How about you, Tim? You love your cars. You're kind of a fast guy. You like the stocks.
I wouldn't say that. I drive an Astra, but I think for us it's a buy. I mean, the stock is not expensive. It's trading on about 12.5 times FY16 numbers. There's a cost out story there that should improve margins this year. There should be a driver for demand in the form of lower petrol prices, which you're seeing occur in the US. So all up, it's an attractive risk-return proposition.
Okay, so Tim and Steve, they like it on the ground, not in the air.